I'm Sean Cooper, president and owner of Fit Financial Consulting, LLC, a registered investment advisor. Over the last few weeks, we've been talking about annuities at length. And last week, we actually talked about when they actually make sense. Today, I want to wrap up the annuity discussion by looking at some of the pitfalls that you're going to want to watch out for if you're evaluating an annuity. One of the things that comes up, regardless of the type of annuity that you're evaluating, is going to be the liquidity of that annuity. So annuities have some tax benefits baked into them, much the way your IRA or your 401k have. And that's because the IRS views annuities as a retirement vehicle. That also means that any withdrawals prior to age 59 and a half will typically result in some very adverse tax consequences. On top of that, most annuity companies are also going to impose some pretty stiff penalties for any early withdrawals from the contract, anything really above a very small withdrawal in the first few years, and that's in the form of a surrender period. So some of these penalties are going to be imposed for anywhere from, say, around 3 years on the very short term to upwards of 15 years or longer on the high end. Frequently, though, you'll probably see surrender periods somewhere in the 7 to 9 year range. And these penalties in the first few years can be upwards of 9%. That means if you take any withdrawal above and beyond a certain amount, they may allow you to take a small percentage initially, say around 5% or something along those lines, but anything above that, and often if you do go above that, it's going to apply to the entire withdrawal, not just the excess amount, you're going to be hit with that surrender period of around 9%. So you want to be sure if you're investing in an annuity that you're not going to need to touch those funds for at least a few years, and preferably not until retirement. Some of the more specific things that you want to watch out for on particular annuity contracts are some of the following. So one example would be on fixed index annuities. And we did talk about this at length in one of my prior videos, so I do ask that you refer back to that, the fixed index annuities video, for more specifics. But fixed index annuities, when you look at your market participation, so your market tie-in to the index like the S&P 500, you really want to evaluate the caps, participation rates, spreads, and other similar handicaps that the company is going to impose that will hamper your growth prospects. You really don't want to overlook these performance dampening restrictions. Another example would be on your variable annuities. So you really want to be mindful of the fees associated with variable annuities, which can easily exceed 3 to 4%, especially when you start to tack on riders. And that's not even accounting for the internal expenses of the underlying funds that you're investing inside of the annuity. And this really plays a major factor when it comes to your odds of receiving a market-based step-up, assuming your contract actually has some form of step-up built into it or built into one of the riders that you can tack on. And what I mean by this is, in order to receive a step-up, you're going to have to overcome not only the fees of the annuity itself as well as the riders, but you also have to overcome the minimum guarantee, because you have to exceed that guarantee before a step up actually comes into play. So an example of that on a relatively inexpensive contract would be, say, a contract with a minimum guarantee of 3% that has the market-based step-up feature and expenses of around 3% as well, which would be kind of on the low end, really, if we're talking about a contract with a rider involved. And then internal expenses on the internal funds of around 1% as well, which would also be more or less on the low end. You add all that together, and what that means is, in order to receive any type of step up, your market returns would have to exceed 7% before you get a step up in basis, before that's even possible. And after you account for the fact that your investments may be restricted by the company, in most cases are restricted by the company, to something no more aggressive than about 80% equity and 20% fixed income, the odds of receiving that step up, of exceeding that 7% return in any given year, are only 47%. And any year in which you miss receiving that step up, so any year that you don't hit that 7% mark, the following years your odds of receiving a step up are even lower. So another example, if we look at a contract with expenses on the high end, so 4% on the cost of the contract, 3% guarantee, and say around 2% on the internal expenses of the funds, you have to receive market-based returns of 9% in order to receive a step up, in which case your odds of receiving a step up in any given year are only 38%. They drop from 47% down to 38%. My point here is not that you shouldn't have guarantees, that you shouldn't have a variable annuity, but that they can be very expensive. And they get more expensive when you tack on these guarantees. So you want to know before you purchase that variable annuity, are you purchasing it for the tax benefits or are you purchasing it for the guarantee? Because if you're purchasing it for the guarantee, you may very well be getting only the guarantee out of it because of the lower odds of receiving market-based returns. So just know that going into it, and it really shouldn't be a problem. The last thing that I want to bring up is in regards to lifetime income. Pretty much all annuities have some form of lifetime income available, but there is a cost to that. So providing that lifetime income, that insurance against longevity risk, has a cost associated with it. And the biggest cost, the one that most people overlook and often causes their contract to blow up later, is in regard to the little to no flexibility with regard to your withdrawals once you start taking that lifetime income. So in the case of annuitization, you're going to receive a specific amount of money on a monthly, quarterly, annual basis, however you set it up, and that amount is only going to change if you've elected an inflation protection rider or if you've elected some kind of survivor benefit, in which case your spouse or whoever the survivor is probably going to receive a reduced amount. Other than those two things, outside of that, you no longer have any control over your withdrawals. On the other hand, if you take a guaranteed withdrawal rate from the company, so you're not technically annuitizing, you're actually taking a guaranteed withdrawal rate from the company, so say around 3, 4, maybe 5% on the high end at this point, in that case you have a little bit more flexibility. So you often in those scenarios can actually turn off the income, or you could potentially even reduce it a little bit. But again, you probably can't increase the income. So if you take more than what's allotted, more than that set percentage, whatever it may be, you are very likely to completely destroy any guarantees that you've tacked on to your annuity. Additionally, unless you've elected a withdrawal option that includes a rider with a death benefit, once the beneficiary receiving the income, so whoever is actually taking the income is technically the beneficiary, so most likely you, once that person passes away, the contract is going to terminate, and there will be no additional benefits after that unless there's some kind of spousal continuation or guaranteed period certain for income. Aside from those additional riders or those particular selections, there are not going to be any benefits after the beneficiary passes. So unless you specifically elect some sort of benefits for the survivors, the contract terminates even if there are additional funds left on the table. So if you die prematurely and you have 80% of your funds still sitting in the account, there's a good chance those funds become the funds of the annuity company, the insurance company. So these are the types of things you want to look out for when purchasing annuities. They can still make a lot of sense, but you do need to understand them when you open the contract, because it is, for the most part, a lifetime commitment when it comes to annuities. As you can see, these annuities have lots and lots of moving parts. And if it's right for you, that's great, but you do want to take the time up front to read all of the restrictions that are imposed on both your returns and your liquidity when you start taking income. As always, if you have any questions, by all means, let me know. This does conclude my conversation and my discussion of annuities. So feel free to reach out to me if you have further questions. 720-808-6979 or sean.cooper@fitfinancialconsulting.com. Thanks.